Hello and welcome everyone. In today's video, we will be taking a look at my margin account portfolio. I started building this portfolio about a month ago, so it is relatively new and also a small portfolio compared to my registered accounts. However, I'm trying an experiment with this portfolio and my aim is to generate an overall income yield of 40% or higher based on the capital invested. I'm using only Canadian listed ETFs and using margin to boost the overall income yield percentage. So let us first take a look at the holdings within this portfolio. And as you can see, we have 6 ETFs in my portfolio so far. HHIS, Biggie, and CDAY account for over 60% of the total portfolio. In addition to these, we have 3 single stock based covered call ETFs based on Shopify, Agnico Eagle, and Strategy. Obviously, since this is a new account, the number of holdings is quite low, but this will increase as we move forward. However, the focus is going to be on buying high-yielding ETFs, whether it is based on a single stock or a diversified fund. Now let us take a look at how this portfolio has performed so far. All right, here we have my portfolio in numbers as of the end of trading day on June 12th, 2026. We can see it is a very small portfolio, and so far I have invested $4,400. Nonetheless, the book value is $5,900, which means I have used a margin of $1,500, which roughly translates to about 30% of the capital invested. And I wish to keep it around that number. So even though I'm aiming for a high yield, I want to keep the amount of margin I'm using within a safe range. Speaking of yield, we have 2 boxes on the right corner that show us the yield on the capital as well as yield on book value. The 43% yield refers to the actual capital invested, which is 4,400. However, based on the actual book value of $5,900, the yield is 32.5%. The other 2 boxes in the bottom row, capital return and total return, are calculated based on the capital amount of $4,400. So we can see that right now I'm down 5.73%, and even after adding in the income that I received in terms of total return, I'm down 4.06%. The markets of late have been quite choppy, so this should not come as a surprise. But the most important box here is the one in the middle in the upper row, which tells us the amount of downside remaining. This is the percentage by which my portfolio needs to drop in terms of its capital value in order to trigger a margin call based on the margin requirements of all the holdings I have. As we can see in the table, in the very last column, I have listed the margin requirement for each ETF. The 3 diversified funds all have a margin requirement of 30%, which is great. Among the single stock ETFs, SHIPI and AEME have a margin requirement of 50%, while MISTI quite rightfully has a margin requirement of 100%, given its extreme volatility. In other words, they are not offering any margin at all. But remember, the 3 diversified ETFs are actually accounting for over 60% of the portfolio. So they are very much balancing any downside coming from the single stock ETFs. Hence, even though we are down over 5%, this portfolio is very much safe as far as the danger of triggering a margin call is concerned. Now, what is my plan moving forward? I wish to keep the overall proportions of my portfolio very similar to where it is right now, which is around 60 to 70% being allocated to diversified ETFs holding multiple companies, and around 30 to 40% being allocated to single stock ETFs. In addition to Biggie, CDA, and HHIS, I will also be adding UTs as one of my core holdings. There are two main reasons why I like the combination of these four ETFs. First, it is a great way to ensure sector diversification since Biggie and HHIS are mainly technology stocks, which are generally high growth as well as highly volatile, whereas CDA and UTS hold more defensive Canadian listed companies and more often than not perform well when technology stocks are down. So any capital downside experienced in technology stocks is balanced out by these defensive sectors. This way, whenever the market is more in favor of high growth tech stocks, the portfolio should benefit by holding Biggie and HHIS, whereas if the market is in favor of more stable defensive sector stocks, then the portfolio should benefit from CDA and UTS. Most important of all, they only have a 30% margin requirement on Wealthsimple, which is crucial since it helps provide a buffer for the more volatile single stock ETFs. Speaking of single stock ETFs, here is my plan for ensuring that I'm minimizing my risks. I will only buy a single stock ETF if I believe that the underlying holding is either oversold or has long term growth potential. In my portfolio currently, I'm holding Shopify, Agnico Eagle, and strategy based single stock ETFs. Among these, for Shopify and Agnico Eagle, I felt that they became oversold about a month ago, hence I bought them. On the other hand, for strategy, I believe it has long term growth potential and it has already been down for quite some time. Although, in hindsight, I do think I could have waited a couple of weeks to buy it cheaper. But then again, nobody can predict that. And with that, we come to the end of this video. I would like to reiterate that this is more of an experimental portfolio that I'm doing to see if I'm able to maintain a high yield of 40% on the capital that I've invested. I'm definitely not recommending this as something people should try. In fact, in future, if I feel that this portfolio has become very unstable, then I might even add more growth and income oriented ETFs like HDIV, even if it lowers the overall yield of the portfolio below 40%. I will provide a weekly update of how this portfolio is doing. And thanks for watching. Don't forget to like, share, and subscribe if you found some value in this video. I will see you all in the next one.